So after we've assessed the risks, then we can think about and design our procedures, think about performing them, and let's think about the different types of control testing we can actually do as auditors. All right, so if I'm thinking about, so if you remember from your AIS course, and I think we've even made this distinction too in the earlier part of the chapter, we can have controls that help prevent material misstatements, controls that help detect, and then controls that help correct, right? And so we want to focus on, when I'm thinking about what do I want to test that I can rely on, I want to test prevention and detection controls, because those are going to keep the material misstatements from happening in the first place. And I'm going to test to make sure that they're operating effectively. And so you'll see that you can have controls that seem to be designed well, right? Maybe they're written, description of them sounds like it's going to do a good job of finding problems or preventing problems, but we really need to see them in action, right? And so the control testing is really, after we've selected the controls we think will do a good job of preventing material misstatements, let's go out and actually test to see whether they are. And so we want to see how they're implemented, and then how consistent are they implemented. So we would look to see, for example, are there any transactions, let's say you have a purchase order that has to get approval. Are there any purchase orders that weren't approved, right? And so we'd be looking for, are there any gaps, any inconsistencies in which the controls were not applied, and how are they applied? If it's through an automated system or a piece of software like an ERP system, then we're going to have more faith that that's going to be done once, assuming those settings are set correctly. We're going to have more faith that's going to be done every time, relative to if it's a manual control where someone has to sign off on something on a physical piece of paper, right? So we want to see and test how those controls are actually implemented and how effective they are. When we're looking then at what that might entail, control testing would include inquiries, which is basically talking, interviewing client personnel. We'll inspect documentation, and let's say there's a report that a manager, a low-level manager, is supposed to review for write-offs, right, for accounts receivable, for example. Then let's see what report was generated. Let's see if it actually was reviewed by the manager and what was done about it, as an example. If we have, when we're doing our walkthroughs, a lot of times part of those walkthroughs become observing the application of controls for a given transaction, right? So let's say if one of the controls is when you enter in a purchase requisition, that you have to have approval in order to have a purchase order that's created. Well, can we look to see that process of actually getting approval on a purchase requisition before it becomes a purchase order? And then lastly, we can include reperformance of the controls. That's more appropriate for things like reconciliations, right? Let's say there's supposed to be a bank reconciliation, and that's a detective control that helps with cash, and so one of the tasks might be to reperform the bank reconciliation for a given period and see if the way it was done by the auditor matches up with how the client did it, right? And obviously you wouldn't want to sit there and look at the bank rec that the client did. You would independently do a bank rec and then look to see what the bank reconciliation looked like from the client perspective. And obviously, at the end of the day, the control testing gets to control risk. And assuming we've already assessed inherent risk, we've already set our audit risk, now we can calculate our detection risk, And so that detection risk then drives the nature, timing, and extent of our substantive procedures. Okay, so one of the set of procedures we can use, or one of the tools at our disposal, is using data analytics. And so we can use it to perform control testing. And so there we'd be looking for operating effectiveness of the controls. Obviously, not using analytics to evaluate the design, we're just using them to evaluate operating effectiveness. And the big advantage is that we're now testing populations rather than a sample. So if, and that's the big difference between that and our historical sustainable procedures, which have always been about, we have a list of transactions, for example, and we need to go back and let's take a sample of invoices and then verify that they were recorded correctly and accurately, and they made it into the sales journal and ultimately into the revenue account in the general ledger. But it's based on a sample. And there's always a risk that the sample doesn't represent the population. Okay? That's called sampling risk. And so the benefit of data analytics is that you take all of the invoices, in our example, verify that those amounts got posted to a sales journal or were posted, for example, to the subsidiary ledger, AIR subsidiary ledger, and ultimately to the revenue account in the general ledger, right? So you can test populations rather than samples. And so you don't have a sampling risk problem. So here they've got another example where basically if you looked at transaction authorization, I'm sorry, the example I just gave you was a little bit more on the, well, it could be, for example, if the example I gave you was, let's say, for example, we want to make sure that all of the invoices make it in, right? There's a completeness assertion. Then we can test to make sure for the number of invoices we have, did that actually make it into the sales journal and the ledgers. And let's say there was a control that was supposed to make sure that they did, right? And so that would be a test of control. If we're looking at accuracy of the invoices, then that really is a substantive procedure. So I want to make sure you're not confused about that. A control test is focused on testing internal control. So if we have a control where there's transaction authorization required for all these sales above a certain amount, then you basically would look at a table of credit sales or invoices, and you can check to make sure, just think about like simple conditional formatting or conditional statements. We're looking for all transactions over $10,000, and then you're going to look for like a column, for example, that has initials of who authorized the credit sale. And so you'd look for any situations in which you had a transaction that was not authorized. You'd also look to see who was doing the authorization and make sure it's the right individuals that are actually doing the authorization. And all that you can do fairly easily with either auditing software or other software like R, or even things like Tableau and some other softwares. This graphic is really just kind of getting at helping us see the consideration of internal control through the different stages. We've kind of largely talked about this already, but this is one of those good kind of summary slides you can look at, make sure you understand it. The one wrinkle here is, let's say we had a situation where the controls do not operate as expected, and so we would have to go back and modify any substantive procedures that we had planned before we perform them, right? Because up here, kind of we're doing this initial risk assessment, and this is largely thinking about it. Oops, let's see if we can write this. Thinking about the design of the internal controls, and so we're planning the test of controls. Oops, it's supposed to be a T and a C, and we're planning the substantive testing. I'll just put a sub there. So those are the two kind of procedures we're planning. So then we do the test of controls, and then based on the results, if everything is as we expected, then we just keep whatever we planned. but if not, then we have to modify relative to what we had planned up here. We have to modify those before we actually perform them. Okay, so it's just kind of showing you how we can get to a finalized set of substantive procedures based on the results of the control testing. Okay, and then just a couple other items here for these two stages of risk assessment and performing audit procedures. One is the work of internal auditors, and the other is a different category of assurance service organization controls. And so let's just chat about those for a couple minutes. So internal auditors can help us in a couple ways. So if we're doing the external financial statement audit, then we can use internal auditors' work that they perform throughout the year to help reduce the substantive procedures that we do as the external auditor. And so they're essentially, we're going to use some of the work they've done. So maybe they've looked at long-term asset impairments over the course of the year, and we see that they've done some testing around that. And so we might, for example, use their work to help give us assurance around the assertions related to valuation for those long-term fixed assets. Okay, so that's one way. The other way is we're actually using them to actually assist with the audit. So that in that situation, we would be directing them to do some of the testing work that we had planned out. So, you know, the keys are going to be competence and independence. So if we think that they're well trained, that they have the expertise they need, we think that that's competence, right? Maybe they're CPAs or CIAs, and so that helps. And they had a good training and good experience. Maybe we feel like we can trust the manager or the director of the internal audit department. That gets to competence. Independence is, do they report to the audit committee, right? Is the audit committee independent from managers? Is the audit committee having good oversight over the internal audit group, right? So that's the independence piece. So that we have to have those two things in order for us to use any work of the internal auditors, whether it's stuff they've already done under their own direction or whether it's work that we're directing them to do. But they could potentially help reduce the amount of work that the external auditors have to do. And then the last topic here is just this idea of service organization controls. So these used to be called SAS 70 audits. Now they're under an SSAE standard from the AICPA. And so this is basically saying, let's imagine a scenario where we have our client, or let's say we have several clients, and each of them have different auditors. So let's say they have a payroll processor, right? Like ADP does payroll processing for a lot of firms. And so in the past, before we had this, and let's say our client is highly labor intensive, so they have a lot of employees, they have a lot of costs that are labor related and flow through payroll. Well, in order to get comfortable around the accounts that are related to payroll, an auditor would have to go in and audit ADP, the portion of the transactions for their client, right? Well, imagine if each auditor has to do that of all the clients of ADP. That's a lot of auditors constantly coming in and auditing ADP, right? The solution is, and there's just some examples. The solution is understanding that there are different services that can be provided, where instead of having each auditor go in, you have one auditor that goes in to the service provider, like ADP. They do a SOC, they have either a type 1 or a type 2, and they do an engagement where they're basically looking at the internal controls and whether, so in the type 1, it's just looking at the design of the controls that the service provider has. Type 2 says we're going to look at the design and how effective those controls are working. Right? So how do they make sure that client 1's data never gets intermingled with client 2's data? Right? How do they make sure that they don't lose any of the client's data? How do they make sure that there's accuracy in the process? Right? All these things. One auditor would go in, test the operating effectiveness of those controls, and so between these two, obviously, if your client uses a service provider and they have a type 2 SOC report, SOC report, then that's a lot more comfort, right? That it's not just the design that's working, but it's also the operating effectiveness. And if that's the case, then you could assess control risk for the assertions that are related to payroll at below the maximum, right? Because you have some comfort that the internal controls are working well. Now you would still evaluate that and look to see, who did the service. Was it an international audit firm or a national firm or a local firm? Or depending on the quality you think that firm can give, that may also determine how much assurance you feel that SOC report gives. But the point is, it's a way to kind of reduce the number of auditors that have to come in to a service provider down to one, and it's much more cost effective to do it that way. And so that could be also part of kind of the stage 3, stage 4 of the audit process, where we're trying to think about audit procedures. Well, if I have a service provider where payroll transactions are being sent, for example, but I have a type 2 SOC report that says everything looks great, designed well, it's operating effectively, then all of a sudden now I have a lot more comfort, and I can now reduce control risk around that account down to whatever level I think is appropriate. And so that's the other way that we would have to get to control risk.